Welcome back. Last time, we discussed pivotal assets crucial for wealth building. Today, we are picking up right where we left off. If you've been with us from the start, we talked about 10 assets investors are looking into in 2024. For our newcomers, you are in for a valuable dive into investments that could reshape your financial future. If you haven't had a chance to watch the first part, I highly recommend you do so. It sets the stage for what we are about to dive into. So, without further ado, let's explore 10 more assets that can make you a millionaire and contribute to your wealth building strategy. Number 11, collectibles. Collectibles stand out for personal joy and financial potential in the diverse landscape of investment opportunities. With investments like gold hitting highs, collectors are turning to items like Pokemon cards, which have seen values skyrocket by over 10,000% since their introduction in 1996, and rare stamps like the inverted Jenny fetching over $1 million at auction. The range of collectibles is vast, from fine art to antiques, stamps, and even wine. However, investing in these items requires care and a deep appreciation for what you collect. After all, as UBS Group survey reveals, 25% of wealthy investors are collectors, driven more by love than the lure of profit. While collectibles can enrich your portfolio, they come with their own set of challenges. Maintenance and care are crucial to preserving their value, not to mention the importance of clearly understanding their worth. Surprisingly, 40% of collectors are unaware of their collection's total value, and more than half have never had their collections appraised. The journey of a collectible does not end with the collector. With 81% planning to pass their treasures to the next generation, it is vital to consider the future of these assets. However, interest varies, with only 35% of heirs keen on keeping these collections. Number 12, peer-to-peer lending. Peer-to-peer lending, or P2P lending, has redefined the concept of earning passive income. For many, it has become the most lucrative source of passive income. Engaging in P2P lending requires meeting certain prerequisites, such as a minimum income level and residing in a state that permits this type of investment. Once these criteria are satisfied, several platforms make it easy with features like automated investing to allow investors to allocate funds across various loans without manual intervention. Through the P2P lending platforms, investors lend out money directly to borrowers, receiving monthly interest payments in return. This process transforms the investor into a lender, enjoying interest income benefits on the loans funded. Investments are diversified across multiple loans or notes, reducing the risk tied to any single borrower. However, like any investment, P2P lending comes with its risks. Borrowers may default on their loans due to unforeseen circumstances, leading to potential losses for the investor. Despite these risks, P2P lending offers potential annual returns ranging between 10 and 36%. This new asset class has gained popularity for its ability to deliver higher returns. For investors new to P2P lending, diversification across different borrowers and platforms is critical to mitigating risks. By spreading investments, investors can cushion the impact of any single default. Peer-to-peer lending is a compelling option for those seeking short-term, high-return investments. Number 13, patents. Patents offer inventors the exclusive right to benefit from their creations. They are a critical commercial tool for inventors, designed to protect and monetize inventions. A patent gives its owner the right to stop others from using their invention without permission. It's a negative right that serves as a crucial commercial tool, enabling inventors to protect and monetize their innovations. Whether through licensing agreements, assignments, or using the patent as collateral for loans, the paths to profit are varied. The prime examples of patents making people rich include the Snuggie wearable blanket that generated over $500 million in sales, and James Dyson, who became a billionaire after inventing his vacuum cleaner. However, obtaining a patent does not guarantee riches. An often cited figure suggests that 97% of patents never recoup their filing costs. This statistic underlines the importance of having a groundbreaking invention and a solid strategy for bringing it to market. For inventors with marketable ideas, licensing becomes a powerful avenue for revenue. Licensing agreements allow patent owners to maintain ownership while earning royalties from sales. With average royalty rates between 5 and 20%, the product's commercial success is paramount. When considering licensing or selling a patent, the valuation can range significantly, from tens of thousands to millions of dollars, depending on the invention's market potential. Inventors must understand the value of their patents and negotiate terms that reflect their invention's worth. Number 14, bonds. Often seen as the bedrock of the investment world, bonds offer a more stable alternative to the stock market. They are loans from investors to issuers, whether corporations, governments, or municipalities. The appeal of bonds lies in their promise of fixed returns and principal repayment. From corporate bonds issued by companies to treasury bills backed by the federal government, each type of bond comes with risks and rewards. For instance, treasury bonds have no default risk since the U.S. government guarantees them. The current interest rate for U.S. Treasury bonds is 5.27%, which applies to bonds issued between November 2023 and April 2024. This rate is made up of a fixed rate and the inflation rate, which adjusts every 6 months. The fixed rate for I-bonds is 1.3%, and the inflation rate adjusts every 6 months. The U.S. corporate AAA effective yield is 4.88%, higher than the 4.5% long-term average. AAA bonds are considered safe, and their interest rates range from 3.8% depending on the bond tenure. The main advantage of investing in AAA bonds is the safety of capital. However, AAA bonds don't offer high interest rates because their demand is high among bond investors. Bonds are a crucial component of a diversified portfolio and offer a steady income stream and less volatility than stocks. However, they are generally not a path to rapid wealth. One of the nuances of bond investing is the inverse relationship between bond prices and interest rates. Rising interest rates make new bonds more attractive than existing ones, potentially decreasing the market value of your bonds. This interplay creates what's known as reinvestment risk, where future investments may not yield the same returns. Municipal bonds, or munis, are particularly favored by high net worth investors for their tax-exempt status, often making them an attractive option for those looking to minimize their tax burden. Municipal bonds are not bulletproof, but they are one of the safest investment vehicles you will find. They also offer substantial tax advantages and are very liquid when held as ETFs. These benefits lead to lower returns, but those returns will be tax-free. Yet, it is essential to recognize that bonds are considered safer than stocks, but are not risk-free. Companies can default, and even government-backed bonds are not immune to the challenges posed by economic downturns. Number 15, ETFs, exchange-traded funds. ETFs, or exchange-traded funds, offer a versatile tool for wealth preservation and growth. With the ability to invest in broad market indices or specific sectors, ETFs provide a straightforward path to diversifying your portfolio with just a single investment. Take the Vanguard S&P 500 ETF, which mirrors the performance of the S&P 500, encompassing 500 of the largest U.S. companies. Or the Vanguard Growth ETF, targeting companies with above-average returns. These ETFs exemplify how investors can gain exposure to various stocks, including giants like Apple and Amazon, through a single investment. When building wealth with ETFs, important considerations include your investment goals, financial obligations, and how to balance growth with income. Controlling the costs associated with constructing and maintaining your ETF portfolio is also crucial, given that some ETFs offer expense ratios as low as 0.12%. ETFs can produce income through stock dividends or interest from bonds within the fund. Investing in dividend-paying equity ETFs, or those that track dividend stocks, provides potential capital gains alongside dividend income. Furthermore, strategies like dollar-cost averaging can enhance your investment's value over time, allowing for the gradual accumulation of more units at varying prices. While ETFs offer an average return of 7 to 10% for broad market ETFs, it is essential to acknowledge that investments can fluctuate. However, the diversified nature of ETFs means the risk of substantial losses is lower than investing in individual stocks. With low fees, diversification, and the ability to tap into various sectors and themes, ETFs represent a solid foundation for any investment portfolio. As evidenced by billionaire investors like Buffett and Dalio, an S&P 500 ETF can be crucial in achieving long-term financial success. Number 16, education and personal development. Investing in education and personal development is one of the most effective strategies for building wealth and achieving personal and financial success. While figures like Bill Gates and Michael Dell remind us that formal education is not the only road to success, their stories are exceptions rather than the norm. The reality is that education plays a pivotal role for the vast majority, acting as a crucial stepping stone to opportunities and higher income. Education equips individuals with financial literacy, crucial for making informed decisions about budgeting, investing, and managing assets. Specialized knowledge gained through education opens doors to high-paying careers in medicine, law, engineering, and finance, directly impacting one's ability to accumulate wealth. The relationship between education and wealth has never been more pronounced in today's knowledge-driven economy. Knowledge leads to financial success and empowers individuals to wield influence and significantly contribute to society. Investing in education is an investment in the future, yours and the world's. While education alone may not guarantee wealth, it significantly enhances the odds of achieving financial stability and success. It reduces poverty and inequality and paves the way for a more equitable and prosperous society. Number 17, health. The adage, "Health is wealth," is a fundamental truth in the journey toward personal and financial success. Good health enriches our lives with the freedom to pursue our goals and is a critical asset in wealth building. Healthy individuals often find themselves at an advantage in the workforce, commanding higher wages and exhibiting greater productivity. Moreover, they safeguard their financial future by avoiding costly medical expenses through preventative care and lifestyle choices. Robust well-being fuels our energy, bolsters confidence, and strengthens relationships. Experts like financial journalist Kelvin Boston, author of Who's Afraid to Be a Millionaire, emphasize the undeniable link between health and wealth. Healthy living prolongs life and enhances one's ability to earn and invest. Number 18, farmland. As the global population continues its upward trajectory, with the demand for food expected to double by 2050, farmlands are increasingly becoming an attractive investment option for investors. Beyond its necessity in feeding the world, farmland offers investors stable, long-term returns, acting as both a tangible asset and a hedge against inflation. As a physical asset, farmland provides security and stability that is not found in stocks or bonds. In times of economic uncertainty, owning farmland means holding an asset with intrinsic value that often appreciates over time, especially in the face of rising inflation, which directly impacts food prices and consequently the value of farmland. Investing in farmland is not just about waiting for land values to increase, but also about generating income. Renting out the land or producing crops can provide a steady cash flow, benefiting from the continuous demand for food. This aspect of farmland investing becomes particularly compelling as the world's population grows, ensuring a consistent demand for agricultural products. Farmland investments also resonate with those dedicated to environmental sustainability and social responsibility. By supporting organic farming and regenerative agriculture, investors can contribute to a healthier planet and bolster local communities while achieving their financial objectives. Number 19, retirement investments. Building wealth through retirement investments is straightforward for many. According to Ramsey Solutions, the path to becoming a millionaire is through consistent contributions to 401ks and IRAs. Investing 15% of your gross income into these tax-advantaged accounts over several decades is a proven strategy for financial growth. For a 30-year-old aiming for a $1 million portfolio by age 65, investing $1,400 monthly at a 3% yearly return achieves this goal. This approach highlights the critical role of compounding interest over time, a principle that turned Warren Buffett into a billionaire. Maximizing your retirement savings is not just about how much you invest, but also how you invest. Utilizing employer match contributions, increasing investments with rising income, and diversifying your portfolio are key. Investing in a mix of stocks, bonds, or other securities through managed funds is essential for risk management. Investing is inclusive, a numbers game open to anyone. The journey from modest beginnings to wealth is possible with disciplined investing and the strategic use of retirement accounts. Retirement investments are a fundamental tool for achieving financial security. By making regular, disciplined contributions to 401ks and IRAs and employing a diversification strategy, reaching $1 million portfolio is within reach. Number 20, cash flowing assets. Cash flowing assets are the engines that can drive financial independence. They generate more income than their maintenance costs, offering a steady income stream with minimal effort. Consider the various cash flowing assets available: vending machines in high traffic areas, efficient laundromats, self-serve car washes, websites generating ad revenue, real estate rental properties, and dividend-paying stocks. These can contribute significantly to your financial health by providing a reliable income source. A strategic investment portfolio includes both cash-flowing and growth-oriented assets. The cash-flowing assets can increase your liquid assets, covering obligations and allowing for reinvestment in the business or distribution to shareholders. While all assets can increase your net worth, significant assets like your primary residence, vacation homes, and rental properties often substantially impact your financial bottom line. And that brings us to the end of another video in our series on wealth-building assets. We'd love to hear your reflections on today's video. Which assets piqued your interest? How do you plan to incorporate these insights into your strategy? Share your thoughts in the comments below. If you have found value in our discussions, don't forget to like, subscribe, and get notified. Thank you for watching. See you in the next video.